And to get you off onto your Monday morning rat race, like we always do. Monday, go to work, go back. I'll keep you up to date with some news stuff. How about that? Again, wolfstreet.com. Asia will be the next source of downside systemic risk for financial markets. Emerging markets turmoil. The price of cheap debt and misallocation of capital. Excess liquidity usually leads to the misallocation of capital, masking any balance sheet constraints. As this tide of excess liquidity recedes, it reveals the misallocation of capital and the mispricing of risk. Nedbank CIB strategist Niels Heinicke and Mihul Daya wrote in a note. And this is particularly the case for excess dollar liquidity in the emerging markets. Sovereign credit ratings, such as those issued by Moody's, Standard & Poor's, and Fitch of the emerging market countries, have dropped sharply since late 2016. In aggregate, they're now solidly into junk, or below investment grade, and have reached the lowest range since the financial crisis, which means, 2008-9 timeframe. Yet, despite the rising risks, investors have allocated large amounts of their portfolio allocations to emerging markets relative to developed markets. These investors were introduced to do so by scanty returns in developed markets, excess central bank liquidity, and the perception that a number of emerging markets have made the necessary structural changes to their economies. Emerging markets in particular, financial markets, in particular financial markets, have benefited from this misallocation of credit, the strategists have written. As the tide of excess liquidity recedes, emerging markets like South Africa will begin to pay the heavy price of this misallocation of credit. In the chart below, the dark green line shows the percentage of portfolio balances, I'll go ahead and share that, allocated to emerging markets, dark green, versus developed markets. Note how this percentage has surged starting in early 2016 and how it recently has begun to recede, which is the outflow of the hot money. Strategists write, one way to monitor the ebb and flow of excess liquidity is by analyzing the changes in the value of the US dollar. As long as the dollar remains the reserve currency and most of the foreign-owned debt is denominated in US dollars, for example in the carry trade, the dollar will remain king. A weaker dollar and a supply of low-cost dollar debt is associated with a stable global environment. And a stronger dollar, they note, is usually associated with volatility and a risk-off phase of liquidity contracts. Since the beginning of 2018, borrowed dollars have gotten more expensive in the emerging markets and hence scarce, as investors that were chasing yield in the emerging markets are suddenly having second thoughts about the risks associated with these adventures. In addition, trade tensions between the U.S. and the emerging markets have added to those risks for emerging market investors. Credit growth in China has slowed, and some commodity prices, which are crucial to some emerging markets, have declined. In addition, the Fed is accelerating its quantitative easing unwind, which has the effect that the market now has to absorb the Treasury securities that the Treasury Department is issuing, and the Treasury Department is issuing even larger piles of them. With U.S. yields being higher and more attractive, they're drawing liquidity from riskier emerging markets. In addition, other central banks are backpedaling on quantitative easing. The European Central Bank, which already tapered its QE program to $30 billion a month, will taper it to zero by the end of the year. And the Bank of Japan has changed its approach as well. Except for an expected short-term reprieve, we expect these tighter USD conditions to remain in place for the rest of the year, the strategists write. That is unless policymakers react soon to stimulate financial markets with liquidity. So what does that mean? If who's the policymakers and how does one stimulate financial markets? We talking more QE? We're going to back off, full steam ahead. What are we talking here? Asia is the elephant in the room. Southeast Asia stands out as, again, like it was in 1997-98, with a large amount of USD denominated debt outstanding. These guys write. The only difference is Then at that time, Asia had fixed exchange rates, and now they're floating. We believe Asia will be the next source of downside systemic risk for financial markets. The chart below shows dollar-denominated debt in the emerging markets in the trillions. Take a look at that. This does not include euro-denominated debt, which plays a large role in Turkey. The fat gray area represents Asia without China. Asia is, in fact, the elephant in the room with 2.1 trillion. Asia's dollar-denominated debt relative to its foreign exchange reserves and exports has risen significantly since 2009, they note. The chart below shows the ratio between dollar-denominated debt and foreign exchange reserves in Asia, with China, which I don't need to really show you, green line, and without China, black line. Values over 50% mean that there is more dollar debt than foreign exchange reserves. And it sure looks that way. This leaves the nations susceptible to shortages in USD, they write. Notably, the Asian nations that have amassed record amounts of USD debt are also home to the largest technology companies, i.e. Tencent China, Alibaba, TSMC, which is Taiwan, Samsung, South Korea. The tech sector is now 28% of the MSCIE Emerging Markets Index. The rally in the US dollar, dented global growth prospects, credit growth in China slowing down, and escalating political tensions from the U.S. leaves these nations very exposed to a shortage in U.S. dollars. It is very evident on this chart below, which I guess I'll put up for the time being, that the changing financial conditions have been the major driver of emerging markets and SA asset prices over the last several years. The risk-on phase ended in January, and all emerging market assets sold off. EM Forex, or emerging market Forex, are however now taking the lead. In the next few days will indicate whether this, stand by. That was the wife, or the whiff calling. Where was I? So the emerging markets Forex are however now taking the lead, and the next few days will indicate whether this will spill over into other asset classes. Chart below depicts, which I already showed, 4 emerging market asset classes through 8/10 of 2018. Again, I already showed that, don't really need to go over that. The strategists conclude a number of studies have emerged, pointing out that the role of global factors has increased relative to country/corporate specific factors. This indicates that investors need to place more emphasis on the role of global liquidity, changing pool money, and credit. A vicious cycle kicked off by cheap debt that is suddenly not cheap after 8 years of experimental monetary policies. Read Rise of the US Dollar Haunts Emerging Market Debt. That's another article from them. Anyways, take care.